For 80 years, the US dollar has reigned supreme at the center of the global economy. But on July 7th, 2026, China switched on the first working piece of a rival system to tear that down. A system anchored not by US Treasuries, but by gold. People have speculated on this, but it's a theory no longer. The infrastructure is up and running, the biggest banks in the world are already involved, and it could reshape who controls the money the entire planet runs on. At first glance, this might look like another piece of standard financial infrastructure, a new clearing system in Hong Kong. But in actuality, it's one of the most deliberate strategic moves in decades, a plan to build an alternative to the dollar with gold at its foundation. So today, we break down exactly what China just launched and who's backing it, why Beijing has spent 20 straight months hoarding gold, and why this shift is going to impact your savings, your pension, and the value of every single dollar you hold. My name is Nick, and this is the Finance Bureau. Now, to understand why this is so important, we need to first consider what the dollar has been for the last 3 generations. Ever since the end of the Second World War,
the unconditional surrender of Japan,
the world has run on one simple arrangement. Global trade is priced in US dollars. And when a country earns more dollars than it spends, it parks the surplus of that in the safest asset it can find, US government debt. That's been the idea. Oil, metals, shipping, debt between nations, almost all of it flows through the dollar and settles in US Treasuries. It gave America something no other country had ever had. The rest of the world lends it money almost for free, and Washington can print the very currency everyone else needs. But there's a catch. And in 2022, the whole world got to see it. When Russia invaded Ukraine, Western governments froze roughly $300 billion of Russian central bank reserves overnight. And that, my friends, showed every country in the world that dollar assets aren't just money. They're money that can be switched off. If your reserves sit inside the Western financial system, they can be frozen with a signature. And that lesson is the seed of everything that is happening right now. Because gold cannot be switched off. A physical metal sitting in your own vault sits outside anyone else's jurisdiction, and no foreign government can freeze it or dilute it. So this is the backdrop against which China decided to make its move. But let's take a closer look at what actually launched. On July 7th, Hong Kong began a trial operation of a central gold clearing and settlement system run by a government-owned body called the Hong Kong Precious Metals Central Clearing Company. A Bank of China Hong Kong was appointed to operate the vaults. And the real heart of it is a new cross-border link called Delivery Connect, which ties Hong Kong directly to the Shanghai Gold Exchange. Put simply, it lets physical gold move and settle across both markets at once. Metal in, payment out. Sitting on the board of this new system are 11 major banks. And this isn't some fringe experiment. We're talking JP Morgan, HSBC, UBS, Citi, Standard Chartered, alongside the giants of Chinese finance like ICBC and Bank of China. Standard Chartered has already pushed its first batch of transactions through it. And perhaps the most telling part is the ambition. Right now, the vault capacity in Hong Kong is around 200 tons. The stated plan is to expand that more than tenfold, toward 2,000 tons and beyond within the next 3 to 4 years. They've also launched a brand new gold price ticker on the Bloomberg terminal, and there's a Yuan-dominated gold futures contract in the works. And here's how Hong Kong is presenting this. Officials said the goal was to turn the city from a price taker into a global price maker for gold, a direct shot across the bow of London, which has set the world's gold price for over a century. As Hong Kong leader John Lee put it, if gold is the world's safe haven, then Hong Kong wants to be its safe harbor. And that's a crucial detail. This infrastructure is built specifically to rival the old order. But that's not all. In the same announcement window, Beijing and Hong Kong more than doubled the yuan liquidity quota for banks, lifting it from 200 billion to 500 billion yuan. So, both gold and yuan liquidity are being wired together in one strategic move. Now, why is China doing all of this? Well, the intent behind this is clear in the numbers. The People's Bank of China has now bought gold for 20 consecutive months. Its official holdings sit at 75.44 million troy ounces, and that's north of 2,300 tons of the stuff. And in June alone, it added roughly 480,000 ounces, its largest single monthly purchase since October 2023. This is a state making a decades-long allocation, buying steadily through highs and lows regardless of short-term price action. And China is far from alone. Some analysts estimate that the BRICS nations' share of global official gold holdings has risen significantly over the past several years, though exact figures vary by the source. The world's central banks are voting with their reserves, and that brings us to the most striking milestone in this entire thing. But before we continue, this is exactly the kind of stuff that we cover in the Finance Bureau newsletter. It's completely free, and every week we break down the moves across gold, currencies, and global finance so you never miss what truly matters. Just click the link in the description or scan this QR code on the left of your screen to get started. Right, back to that milestone I was mentioning. According to a European Central Bank report published in June, gold has now overtaken US Treasuries to become the largest reserve asset held by the world's central banks. Gold now makes up 27% of global reserves, up from 20% a year earlier. Treasuries have slipped to 22%, down from 25%. For the first time since the 1990s, central banks collectively hold more gold than American government debt. Total central bank gold holdings now sit at over 36,000 tons, levels not seen since the era of the Bretton Woods itself. Now, to be clear, much of that is down to gold's price. Gold surged around 60% in 2025 alone. And if you held prices flat, treasuries would still be ahead. Central banks are simply buying gold year after year, and that gold is now worth far more. But the point is that they're only buying, and they're not slowing down. In a World Gold Council survey, 74% of central bankers said they expect the dollar's share of reserves to shrink over the next 5 years. And 89% expect the world to hold more gold. These are the people who manage the planet's reserves, and they're telling you where this is going. So, gold is the anchor. But an anchor is useless without a currency to move it, and this is where China's real ambition comes into focus. Because building vaults is only half the plan. The other half is making the yuan the currency that flows through them. Just look at what's been happening in trade. There have been growing reports of oil trade between Saudi Arabia and China settled in yuan rather than dollars. Now, most exports are still priced in dollars, and no official shift has been confirmed. But even the discussion would have been unthinkable a decade ago. China's payment network, its answer to the Western system, processed a record 1.22 trillion yuan in a single day this year. And in June, Beijing authorized Standard Bank, Africa's largest lender, together with ICBC, to run as the Yuan Clearing Bank of Africa. And that covers 19 African countries, letting businesses trade directly in yuan and skip the costly double conversion through the dollar entirely. Now, let's put all of this together. You have gold as a neutral collateral that no one can freeze. You have the yuan as the currency moving across new rails in Asia, the Middle East, and Africa. And you have a system where oil, metals, and goods can eventually be priced and settled without ever touching the dollar. That's the vision. This creates a parallel system where gold provides the trust and the yuan serves as the interface. And analysts actually have a name for this. The strategist Zoltan Pozsar called it Bretton Woods 3, a world splitting into a dollar bloc and a rival bloc running on commodities and the yuan. 6 months ago, that sounded like a thought experiment. But now, the system is live. But we need to consider some things here before getting ahead of ourselves. The dollar is nowhere near dethroned. The dollar still makes up around 56 to 57% of allocated foreign exchange reserves, though that share has been gradually declining in recent quarters. It still handles roughly half of all global payments, while the yuan sits at just 2 to 3%. Foreign holdings of US Treasuries hit a record $9.49 trillion in February, and gold has its own problems as a reserve asset. It pays no yield, it costs money to store, and its price swings hard. It peaked near $5,600 in late January and then fell sharply in March and sits around $4,100. JP Morgan, one of the very banks of this new clearing board, recently slashed its year-end gold target to $4,500, down from a prior $6,000. This is a multi-year structural play that will take time to fully unfold. But that doesn't mean it won't affect the everyday person today. Because you might be thinking, well, Nick, this is all central banks and foreign trade. What does this have to do with me? Well, a lot. Because if the dollar slowly loses its monopoly, the consequences hit you directly. For 80 years, the world demand for dollars and treasuries has let America borrow cheaply and kept your currency strong. And that demand is what holds up the value of every dollar in your bank account. If foreign buyers of US debt thin out over the coming decade, the interest rate on that debt has to rise to attract them. Higher rates on government debt feed into your mortgage, your car loan, and the cost of everything bought on credit. And if you hold cash, a weaker dollar means your money buys less abroad and less at the pump. If you hold a pension or an index fund, a shift out of treasuries reshapes the bedrock those portfolios are built on. And if you own gold, you are, whether you meant to or not, positioned on the same side of this trade as the central banks of China, Poland, and half of the developing world. And that, my friends, is the reality of de-dollarization. It's a slow rise in your borrowing costs and a slow fade in what your savings can buy. So, who wins and who pays in this new arrangement? The winners are the states that saw the Russia lesson and moved early. China, sitting on thousands of tons of metal it can never have frozen, building the system everyone else will eventually need. The central banks, buying the discount with decades-long horizons and the deepest pockets on earth. They're securing their independence while the getting is good. The ones left exposed are the ordinary savers in the dollar world who were told correctly for 80 years that dollars and government bonds were the safest place on earth. And that assumption held for 3 generations. But it is now being tested for the first time since Bretton Woods. The era of the unchallenged dollar, the one the whole world simply took for granted, is starting to look less untouchable. And the most important shift in global finance in decades may have begun on an ordinary Tuesday in July, while few were paying attention. Well, that's all we have time for today. But what do you think? Is this the beginning of the end for dollar dominance, a gold and yuan system that pulls the world off American debt? Or can the dollar's sheer scale shrug this off for another generation? Let me know your thoughts in the comments down below. And if you want to understand why gold has been so volatile this year despite all of the central bank buying, then you can check out a video on that right over here. And that's all from me today. As always, thank you guys very much for watching, and I will see you in the next video. This is Nick, signing off.